It's the soundbite that dominated headlines yesterday. Poland has shot down Russian drones, and as the dust settles on this incident, many are asking what this means, not just geopolitically, but economically too. Well, if you're concerned about how this conflict is going to play out, then we suggest keeping a close eye on these 4 indicators. Volatility is the first. Now, we don't mean earthquakes or volcanic eruptions. What we mean is the kind of turbulence that impacts financial markets, from currencies to commodities and everything else in between. Now, let's zoom in on Poland. Its currency, the złoty, has been on a bit of a wild ride recently. Let me show you some numbers. At the start of February 2023, €1 was equal to roughly 4.46 złoty. Fast forward to today, and that same euro now buys you 4.58 złoty. That's a depreciation of nearly 3%. In other words, the złoty has lost value compared to the euro. But when we look at the bigger picture, the decline is even starker. Compared to the US dollar, the złoty is down almost 11% in the last year alone. So why is this happening? Well, there are a few reasons. One is speculation. Investors are essentially betting on how the conflict will evolve and factoring in the potential fallout into their currency exchange rates. Another reason is interest rates. The higher the perceived risk, the higher the required return. And guess what? Poland's central bank has raised interest rates to counterbalance that risk. As of December 2023, the base rate in Poland stood at 6.75%, one of the highest in the Eurozone. It says this combination of speculation and higher interest rates that has put downward pressure on the Polish złoty. But it's not just about the conflict. It reflects broader trends in the global economy, including a stronger dollar due to higher US interest rates and economic uncertainty across Europe. But we are here to tell you about the economics of war, and the second E in that is energy. This is a critical one. Poland heavily relies on energy imports, particularly natural gas. Now, before you ask, yes, Poland does have its own gas reserves in production. But it's not enough to meet domestic demand, so they import from elsewhere, according to data from the European Commission in 2022. Poland imported around 10 billion cubic meters of natural gas, most of which came from Russia via pipelines. And while Poland has managed to diversify its gas sources since the conflict began, diversifying away from Russia, it still needs those supplies to keep the lights on and the factories running. But with the current events, there are concerns about the security of these energy supply chains. The risk of escalation is a very real concern for Poland and its neighbors. If the situation worsens, it could disrupt energy supplies and drive up costs. This would add to the existing inflationary pressures and could slow economic growth. But the economic impact doesn't end with energy. Supply chains are also at stake. Poland is a major transportation and logistics hub in Central Europe. It's home to many important industries. According to the World Bank, in 2021, manufacturing added about $300 billion to Poland's economy, accounting for around 20% of its GDP. These sectors rely on smooth and secure transportation networks to function efficiently. But disruptions due to the conflict could lead to delays in deliveries, shortages of materials, and higher transportation costs. All of this adds to the overall cost of doing business and can ultimately affect a country's economic output. And speaking of output, the fourth economic indicator to watch is expenditure, particularly government expenditure. Poland has already allocated billions of dollars to its defense sector. Now, according to data from the Stockholm International Peace Research Institute, Poland's military spending reached $44.4 billion in 2023, up from $13.9 billion 5 years ago. That's an increase of more than 225%. Now, this trend is part of a wider pattern in Europe. In the last year, defense expenditure across Europe rose by 15%, with some countries like Poland and the UK increasing their budgets by as much as 30%. The economic argument for such spending often revolves around the concept of opportunity cost. Every dollar spent on defense is a dollar that cannot be spent on public services like healthcare and education or on green energy infrastructure. This highlights a significant economic dilemma for nations, balancing security with prosperity. In conclusion, the recent developments in Poland serve as a stark reminder of the economic consequences of geopolitical tensions. From currency fluctuations to energy security, from supply chain disruptions to shifts in government expenditure. The ripple effects of conflict touch every aspect of a country's economy. Now, understanding these economic indicators is crucial, not just for investors and businesses, but for anyone looking to navigate the complexities of our interconnected world. So keep watching this space because we will continue to bring you analysis on how global economics is faring. Thank you for joining us.